I'm Dylan Radigan. I've interviewed nearly every CEO and most world leaders during the past 25 years. And now on Bootstrapping, I'm turning my attention to the new CEOs and the irrepressible entrepreneurs leading the next generation of innovation in the world.
Welcome back to tastylive. I am Dylan Radigan. Time for another episode of Bootstrapping. Our guest today, Eva Shang, the company Legalist. Imagine you have, I don't know, $700-800 million. And imagine you're going to do customized credit lending, meaning you're going to try to size up the probability that a company is going to get paid on a government contract. You're going to try to size up the probability that a piece of litigation is going to get paid. You're going to size up very peculiar and unusual credit situations, and you're going to do it so well that you become one of the youngest people ever to be given custody of hundreds of millions of dollars. That is what Miss Eva Shang has done, or at least a small part of it, because I don't know that much about you, Eva. I'm sure you've done even much more than that. And I'm curious how you even begin to price credit on some of these, there's some of these situations. I'm sure there are no comparables. It's just that situation. There's not like you can look at all the comps, all the BBB rated corporate bonds out of Germany. No, like what are the chances that the government contract in Sonoma County gets repaired and gets paid or whatever it is? And so I'm very curious, both in your description of sort of the nature of the custom credit that you look at, and how you even begin to price probability of payout.
That's a great question. And then to answer that question, I would have to kind of tell you a little bit more about the company and the funds we manage and what we do. As you kind of alluded to, I'm one of the co-founders and the CEO of Legalist. I started the company when I was an undergrad at Harvard. So my co-founder and I dropped out of Harvard in 2016 to start this company and to take it through a Silicon Valley startup accelerator program known as Y Combinator. Now, back in the day, the technology that we built, it had only one purpose, and the purpose was not to invest in alternative credit. The purpose of the technology that we built was we scraped public court dockets that were run by various state and federal government entities, and we were looking for analytics on those court cases that we could in turn sell to lawyers. And it was only after we got into Y Combinator that the general counsel at Y Combinator was like, I don't like your company idea. And we had just dropped out of school, and we were like, what do you mean you don't like our company idea? And what he said was, it's very difficult to sell anything to lawyers because lawyers bill by the hour. They don't have an incentive to be right. If you think that you can be right, if you think that you can tell which cases are going to be successful, you shouldn't sell that information to lawyers. You should start an investment fund. With an investment fund, you can monetize the fact that you have this information and that you know that you're right.
So you said don't sell the information to lawyers, become a litigation finance company.
Exactly. Mm-hmm. Yeah. If you've ever dealt with a lawyer, then you'll know they don't really have an incentive to be efficient. In fact, they have an incentive to be as inefficient as possible. So his advice made a lot of sense to us. And that's really how in 2017, we launched our first ever litigation finance fund. And that was a $10 million fund. And it was an extremely difficult fund to raise because you had these two college kids with no investment experience who didn't even have a lawyer on the team, and they claimed that they knew which litigation cases were going to be successful.
That's where my question, that's where I'm most interested, which is what information were you then and are you now? You're obviously weighting some piece of information. You're like, is it who the law firm is? Like if it's this law firm, the probability of success is higher than if it's this law firm. Or like, I'm just interested in like, what are the top even 5 variables that you thought influenced probability of success?
Yeah. So the things that are most correlated with whether a case is going to be successful is whether it has been successful to date and how far along it's gotten. So if you take a step back, in the movies, cases always go directly from filing to trial, like within the span of days. But in reality, it actually takes about 2 years. And during the 2 years, you have all these kind of mini skirmishes between two parties. Some of these are dispositive. So dispositive motions are motions that could potentially throw out the case altogether. And some of the cases, some of the motions are procedural, but even procedural skirmishes have they relate to some sort of information that one side is trying to protect or trying to get the other side to disclose. So the more of these little skirmishes you're successful at, and certain skirmishes are more important than others, the more likely it is that your case is going well, right? So in the interim, before you even get to trial, a lawyer has a general sense of whether their case is going well. And that's
Meaning,
really
like,
what
this is simple things like this could be like a motion to dismiss, or a motion to
exactly.
change the jurisdiction, or a motion to include or exclude some piece of evidence. And you're saying
Exactly.
you were looking at
Exactly.
to see, like, oh, this case, they tried to dismiss it, they couldn't dismiss it. They
Right.
tried to change the jurisdiction, they couldn't move the jurisdiction. They tried to eliminate the evidence, they couldn't eliminate the evidence. And then you stack a bunch of those up and say the chances that this thing has success is higher than it would
Exactly.
otherwise be.
Exactly. So we still, I mean, so we still have, even today, lawyers on staff who look at a case after we've selected it using the technology for investment. Because the question is, how much is the case worth and how much are you going to invest in it? Even if the case is going to be successful for $1 million, if you invested $10 million into that case, you would have just lost 9 million. So it's really important still for us to do underwriting. But our pitch to investors back then, as it is now, is that we can take a lot of the work out of the beginning of the process because we have a bird's eye view on all the litigations out there, and we can tell you which ones are already going well and just pick from those.
So
So
the
that's,
technology, if I understand, filters basically
yes,
for higher probability scenarios based on what we
exactly.
just discussed. And then there's a more in-depth discussion from human
Yeah,
beings about economics, cost, duration, etc.
of course. Yeah. So there's an in-depth underwriting process afterwards. If you think about, how a litigation investment works, there's really liability, which is the case going to be successful? Damages, if it's going to be successful, how much it's going to be successful for, and collectibility. And the last one, collectibility, you cannot tell at all just from the court docket or the publicly available data. It really comes down to if you get a judgment for $1 million, is there someone on the other end that even has $1 million to pay? And so that's a kind of a subjective call at the end of the day by our team. But the fact that we have this technology is what really allowed us to get started to at least cross out one of the three factors.
Yeah. I have a couple of friends who are very sort of plaintiff lawyers for large law firms. And
Okay.
I know they will only take cases on contingency, which would be the equivalent of taking
Mm-hmm.
litigation finance. Like, yes, sure
Mm-hmm.
probability of payout, sure liability, but they have, honestly, the collectibility is the primary variable for them, which is
Yeah.
why they'll basically only do it if it's a large publicly traded bank or pharmaceutical company. And if
Right.
it's not
Right.
a
Right.
bank, or if it's not a large public company, they won't even bother. They're like, yeah, we
Right.
can
Right.
win. They're like, it's $200 million in damages and you'll definitely win. And you're never going to see the money because, you're collecting from the squirrel on the corner, kind of a thing.
Yeah. Yeah. Exactly. Exactly. So litigation finance has a lot more aspect to it than I think we initially thought when we raised our first $10 million fund. And these were all things we had to learn as we went along. But I think the other difference between us and a contingency attorney is that a contingency attorney is basically using their own time. They're also litigation funders. They just invest their time, and they're often investing on a lot less information than we are because it's very rare for a contingency attorney to have the information from the first half of the case before they make an investment, so to speak. Whereas for us, there's usually already a lawyer involved. The case has been going for a while, so we have some information to go off of. So we're lucky in that way. Contingency attorneys have a really hard job.
Now, the fund today, which has, as I understand it, more than $750 million, is it still purely a litigation finance fund, or have you broadened your mandate?
Yeah, so after that first $10 million fund, we were stuck there for a little while because investors wanted to see whether we could make that 10 million turn into more money. And there was a big question mark. And it wasn't really until 2019 that we started to have some really positive results come in and we raised the next 100 million. So today, that first $10 million fund has yielded more than a 2x multiple for our investors, and we manage around 800 million of assets across 3 different strategies. So our litigation finance strategy was the first one. Then we launched a strategy in bankruptcy where we lend against unique M&E in the bankruptcy court, machinery and equipment, other real assets. And then finally, our most recent strategy, where we're about to close on another 200, is our government receivable strategy. So the government receivable strategy works on roughly the same premise. So you can think of it as like you have a small business that has a bank line of, a few $100,000. Every year they make a couple million of revenue. This government contractor has recently been awarded a very large government contract. And the reason that these small businesses frequently get awarded large government contracts is because the government actually has a policy mandate to award contracts to small businesses. So the SBA posts a statistic every single year about how many contracts it awarded to small businesses. And there's a special preference for women, minority, disabled, and veteran-owned businesses. So you have these underrepresented groups who run small businesses who have been awarded large contracts. And they go to their bank and they say, I'm about to have like a huge inflection point in my business. And the bank says, I don't really know how that changes my perspective because I'm going to look at your P&L for the last 2 to 5 years. And you have no evidence that you're going to make more money next year than you did last year. Whereas what Legalist does is because we find these large contracts as they're being awarded to disproportionately small players, we can proactively identify that they're going to be awarded a contract of the type that we would like to lend against. And so we help to bridge that time period in between when they are meant to do the work and 3 or 4 months later when they actually get paid by the government. And so
so I actually founded a business that was a small business that received a very large government contract. So I'm familiar with
congratulations.
I'm a good person to interview you.
Yeah,
so
that's great.
But I am curious. I assume you're lending before the actual contract has been awarded. Like the way the contract process works, as I'm sure you know, is there's what's called spiral 1, spiral 2, spiral 3, where basically the small business moves through a set of vetting and discounting in order to advance to the final award of the contract. And I'm curious where in the contract vetting process Legalist comes in to provide financing. And the reason I ask, or do you wait until the contract has actually been awarded? And are you saying that if the business goes to the bank and say, I have this contract for $10 million to do all these solar panels in San Diego or whatever it is, that the bank will say, well, no, we're not going to lend against that contract because the biggest deal you've ever done before this was $150,000 and you've never done something like this, et cetera, et cetera. In other words, do you wait until the contract has been awarded, or will you allocate financing in anticipation of the contract award?
So we only detect when the contract has been awarded, and we measure that contract against contracts that they've done in the past. So most of these contractors, you can see what contract they've done in the past. And if it's been like 500,000, 2 million, 2 million, 50 million, that jump is really what triggers us to reach out, knowing that they now have a new credit need. But the reason that our
so you're looking at their history of at some threshold, hundreds of thousands or 7, and then all of a sudden you see a big bump to an 8 or a 9-figure award, and you're like, oh, these guys are going to need some money.
Exactly. And the type of financing that we provide, it is both more flexible and less flexible than bank lines. So a bank line, it's very low interest rate, right? So that's good. But they're really underwriting you based on a blunt instrument. And that blunt instrument is your P&L from the last few years. Whereas we're not very interested in your P&L. If you made a lot of money last year, great. If you didn't, that's also fine. We're interested in the specific text of the contract itself. When are you going to get paid? Under what circumstances? What's the timeline between when you get issued a purchase order or a task order and the date that the work has to be completed and the date that the government has to pay you? And so we lend in the operating cycle for a very short duration to bridge that gap between when they have to outlay expenses, i.e., cover payroll, buy supplies, and when they actually get reimbursed for that from the government. So most of these, I'm curious what type of contract your business had, but most of our borrowers are labor and services where there's a huge outlay of costs on the front end.
Yeah, the contract we did was a firm fixed price contract for industrial infrastructure. So it was more on equipment. It was a $65 million contract for a lot of, but it was more, there were a lot of jobs, or maybe 1,000 jobs, but it was mostly gear. And actually there was, and the contract was set up with, it was very favorable to the company in the sense that the contract was set up with advanced payment. But anyway, so it made it, it was a little bit different, but it's still, so how have the returns been for that? Like, in other words, if you look at the returns on your litigation finance versus your returns on government receivables versus your returns on the bankruptcy business, which that's the one I'm the least familiar with, knock on wood. But how are the returns? How do those three different deployments compare in terms of return and duration?
That's a great question. So we consider all of the assets that we cover as part of alternative credit. And alternative credit refers to anything that is not a standard corporate lending line. It's difficult to source and it's difficult to underwrite. And that's why it's alternative. But then on the other hand, that's why the returns are disproportionately good compared to the risk. Most of these asset classes are not very scalable. And the fact that we have this technology where we can source them at scale is what allows us to really grow our business beyond more than just like a small specialty lender. So all three types of alternative credit, and what makes it alternative is that it is difficult to source and difficult to underwrite, which makes it difficult to scale. And it's really the fact that we have this technology which allows us to scale it effectively. So of our three strategies, our litigation strategy is our most equity-like. And so that one targets a 20% plus net IRR, which is comparable to private equity. Our bankruptcy strategy is a senior secured lending strategy within bankruptcy. And that one is the most capacity constrained because there are not very many bankruptcies every year.
Legalist, the company, Ava Shang, the executive, Bootstrapping, the segment, tastylive, the network. I'm Dylan Radigan. We're back with more after this.